Today we're diving into, well, a real paradox in high-growth finance. We've got a company valued in the billions with a B, yet currently generating $0 in revenue. We are plunging right into the volatile world of urban air mobility, and specifically the really complex financial picture of Archer Aviation. So our central disagreement is this. Does Archer's, aggressive operational momentum, and you combine that with its immense strategic funding, does that actually justify its current multi-billion-dollar market valuation? Or does the reality of massive capital burn and, frankly, significant regulatory risk make this investment fundamentally speculative? Now, I'm arguing that Archer's strategic wins, its deep financial war chest, they position it for future market dominance, and that validates the growth valuation.
And I guess I come at it from a slightly different angle. Look, the narrative of flying taxis it's certainly compelling, right? Who doesn't find that interesting? But the core financial structure, it demands extreme caution. I'm going to contend that the persistent absence of any commercial sales, the widening net losses, and maybe most importantly, the unresolved litigation and regulatory hurdles, they fundamentally overshadow the operational progress they've made. The market, I think, is pricing this stock currently around, $8.18. It's pricing it entirely on hope, and that constitutes an excessive, frankly, unmanaged risk.
See, the current market cap nearing $5.3 billion, I think it reflects the anticipation of successful execution, not really the current cash flow. It's a first-mover valuation, and it's underpinned by profoundly strategic partners. You mentioned zero revenue. Okay, fair enough, but I see hundreds of millions in committed capital. Stellantis, one of the world's largest automakers, they've committed up to $150 million. You've got United Airlines placing large conditional orders. And crucially, the company has secured a massive cash runway, bringing total liquidity to over $2 billion after some recent equity raises. That's the financial safety net they absolutely need to withstand the intense cash burn required for this pre-commercialization phase.
This company reported a trailing 12-month net income loss of, get this, $612.8 million. That is a vast figure for a company with absolutely zero sales. And the volatility baked into this valuation is extreme. The stock carries a beta of 3.11. Now, for listeners, that basically means Archer is theoretically moving, 3 times more violently and unpredictably than the overall market. So when you combine that degree of volatility with a complete absence of commercial revenue, well, the risk profile becomes, frankly, completely unsuited for anything but the highest risk, speculative capital.
But volatility is the price of entry, isn't it? Especially in a nascent, revolutionary market. And look at the long-term performance. 151% return over 1 year. That shows that long-term investors have profound conviction in the whole EVTL thesis. They believe the risk is commensurate with the potential reward. Let's address that capital burn you mentioned.
That $2 billion cash pile, yeah, it looks immense on paper. But their expected quarterly free cash flow burn is approximately $120 million, quarter after quarter. Furthermore, management's initial production plan, well, it targets only 50 aircraft per year. Just 50. At that kind of output level, the revenue generated, it's going to struggle mightily to offset that $120 million quarterly hole. The market uncertainty here is just so high that valuation models are, frankly, all over the map. One DCF analysis I saw suggests an intrinsic value as low as $163. While, the most aggressive growth models hit almost $30. This chaos suggests the market price of $8.18 is simply detached from any kind of consensus reality.
That disparity, I think it proves the binary nature of this investment. The lower models, they're pricing in regulatory failure. The higher models are pricing in significant market capture. The fact that the stock is trading somewhere in the middle suggests the market is assigning a very real probability to successful execution. And that execution, well, it's secured by the balance sheet. Their debt-to-equity ratio is almost non-existent. It's 0.05. More importantly, their current and quick ratios. They're extremely high, around 22.3. This isn't just a number. It means they have something like 22 times the liquid assets needed to cover their immediate liabilities. This is a fortress of cash, specifically designed to absorb that burn rate until they hit commercialization.
But it doesn't guarantee wise deployment of that capital.
But the deployment is profoundly strategic. Consider the $126 million acquisition of control over Hawthorne Airport in Los Angeles. Now, this is far more than just an operating expense. This move secures essential infrastructure control right in the critical LA market. It positions Archer as the central hub for the air taxi network ready for the 2028 Olympics. They are actively creating a barrier to entry for competitors by securing physical landing real estate. That's a capital investment in future operating leverage, not simply, burning cash aimlessly.
Okay, infrastructure control is one thing, but it's meaningless if the aircraft isn't legally cleared to carry paying passengers. We absolutely must look at the regulatory and legal risks, which I believe are frankly severely underestimated.
Well, Archer has significantly de-risked the technology itself. The Midnight aircraft has completed essential flight testing, including a high-altitude 10,000-foot flight. They have also secured their Part 135 Air Carrier and Operator Certificate that allows them to conduct commercial air operations, and in the Part 141 certification for establishing their own pilot training academy. They are not just developing a plane here, they're building the entire ecosystem that the FAA requires. Furthermore, the acquisition of Lilium's extensive patent portfolio, we're talking around 300 advanced air mobility patents, that materially strengthens their intellectual property position and mitigates long-term competitive threats. And look, they're leveraging global partnerships with Korean Air and the Japan Airlines Sumitomo JV for rapid international expansion, targeting commercial operations in the UAE by, I think, Q3 2026. That diversifies them beyond just the FAA timeline.
The core risk, the absolute critical step, remains FAA type certification, the pivotal type inspection authorization, or TIA. That's only anticipated by the end of 2025. Anticipated. This is the stage where the FAA scrutinizes every nut and bolt of the manufacturing and safety systems, and historically, this process, it's where unexpected delays can kill timelines. We've already seen delays push their international passenger flight targets to 2026. But maybe even more concerning is the legal environment, which just drains capital and management bandwidth.
Okay, what specific legal concerns do you find most material then?
Well, the company is facing a shareholder class action lawsuit related to the 2021 SPAC merger. It alleges misrepresentation during that process. Now, while they fight these claims, litigation costs are immense, and they inevitably detract high-level executives from focusing on the incredibly complex production ramp-up that's needed. Additionally, there are persistent reports, of ongoing inquiries from the SEC and state regulators regarding data collection practices. This kind of regulatory scrutiny creates an unpredictable overhang that technical progress alone just cannot solve. Management attention diverted to fighting lawsuits is attention taken away from achieving that crucial TIA, and that is a direct financial cost, plain and simple.
Look, all revolutionary high-capital companies face litigation and regulatory scrutiny in their infancy. That's almost the cost of pioneering, isn't it? This risk, I think, was managed by the fact that they have locked down perhaps the most challenging partner they could need in their future, Stellantis.
Okay, that brings us neatly to investor confidence and the crucial issue of dilution. Institutional ownership, yes, it's high at nearly 55%, but the analyst consensus price target average, it's around $12.71. And while that's higher than the current price, it still leaves a pretty wide margin of error given the volatility and the risks we've discussed. What concerns me is the behavior of the insiders and the skeptics. The short flow percentage sits at a significant 13.90%. That shows pretty strong conviction from sophisticated market participants that this stock is, overpriced.
Okay, that high short percentage reflects skepticism. Yes, I see that. But let's counter that with conviction. Stellantis, which, remember, committed to be the exclusive contract manufacturer. They are not just a partner. They are a 10% owner. This commitment fundamentally de-risks the entire manufacturing pipeline, which, let's be honest, is often the graveyard for new aviation ventures. Their asset-light approach, relying on Stellantis' expertise and scale, that's a massive advantage that I think the skeptics are overlooking.
But the insiders themselves seem to be signaling opportunistic exit. We have documented repeated sales transactions by multiple executives and directors throughout 2024 and 2025, often right after option exercises when the people closest to the operation, we're talking the former CFO, the CTO, are repeatedly selling off shares at prices in the $7 to $13 range. Well, it suggests they view the current market pricing as an opportune moment to liquidate some holdings. That fundamentally undermines the narrative of supreme confidence in massive future returns, doesn't it?
Insider sales. Well, they're often complicated by compensation structures, lockup periods, timing restrictions. They don't necessarily signal a lack of faith in the long-term vision. The most profound evidence of market conviction, I think, is the sheer resilience of the stock price, despite the volatility, and the continued commitment from these corporate heavyweights. Stellantis' buy-in and their commitment to manufacturing validates the scalability of the entire endeavor. And the dilution, yes, it happens. Resulting from necessary equity raises, that's simply the required cost of acquiring the financial safety net needed to achieve commercialization in a regulated, incredibly capital-intensive industry.
Dilution means that every single time they raise capital, they are effectively printing new shares, which shrinks the size of the eventual profit pie available to existing shareholders. You're betting that the pie will grow exponentially faster than the share count increases, which is a massive leap of faith when you're facing down that $120 million quarterly burn rate with zero revenue coming in.
Look, Archer has transformed itself from really a white paper concept into a global enterprise. It has strong technological IP backed by key patents, strategic manufacturing through Stellantis, and robust liquidity. It's all focused on the immediate commercialization horizon 2026 and the LA 2028 Olympics. The current valuation I maintain is merely pricing in the high probability of execution in a market that is genuinely set to revolutionize urban transport.
That's a compelling argument, I'll give you that. But it's based entirely on future projections. The cold financial metrics, the persistent, expensive regulatory hurdles, the legal risks, they dictate extreme caution. Zero revenue, colossal net losses, unresolved litigation. It means the market is trading entirely on promises right now. Investing in Archer remains, in my view, a highly volatile binary bet on the ability to achieve absolutely flawless execution in the face of unprecedented certification challenges.